everyone. I'm Tracy Dolin Benguigui. I'm the P&C sector lead, and I'm very pleased to moderate in the driver's seat a reinsurance buyer's guide. Some of the themes that we'll cover might be similar to the prior two panels, but the twist here is that we're getting the reinsurance buyer's perspective. And I also have to admit a very global perspective based on where our panelists are representing their companies. For the last number of years, we've noticed there has been reinsurance arbitrage amongst the largest buyers of reinsurance. And not only have they seen favorable pricing, but also favorable terms and conditions. And post-events, we really like to explore, does that still exist, and how they view their reinsurance strategies. So with that, I will like to make a quick round of introduction for my panelists. On my left is Scott Belden, who is the Senior Vice President of Reinsurance for Traveler Companies. John Parry sits right next to Scott, and he's the Chief Financial Officer of Lloyd's of London. And Jim Fiore on the very left is the President of Equator Reinsurance, who's a reinsurance captive of QBE. Just like the prior panels, we are going to go through first a polling question, and then you do have your app so you could submit questions to me through the course of the discussion, but we would like to reserve the actual Q&A for the last 10 minutes or so. With that, I'd actually like to kick it off to our polling question, which is, what is the best estimate of insured losses from hurricanes Harvey, Irma, and Maria? Is it between 40 and 60 billion, 60 to 80 billion, 80 billion to 100 billion, or your guess is just as good as mine? Maybe with that, we'll start with the Jeopardy music. Okay. All right, we got some clear bias for the 80 to $100 billion camp with 50%, followed by 60 to 80 billion. And I would say maybe the 80 to 100 billion is kind of consistent with maybe some of the largest insurance executives have stated. I think Mike McGavick just mentioned 90 billion earlier today, and Evan Greenberg mentioned on the third quarter earnings call between 80 and 100 billion. So maybe I'll just start there and just acknowledge that while the overall maybe consensus is somewhere closer to the 80 to 100 billion, what really explains this gap between what we've seen in reported losses that looks somewhere close to 30 billion? So maybe with that, I'll turn to John, and maybe you could help explain the gap between the reported losses and what the modeling agencies are saying in street consensus.
Thank you, and good morning, everyone. I think we played this guessing game before, back in 2005 with Katrina, of adding up loss announcements and comparing it to what it might be. I guess probably quite pleased that about half have gone for the 80 to 100, because at least that's consistent with what most firms have actually announced with their loss estimates, so people are being consistent. I think what it does tell us is that people are largely discounting the top end of the modelling firms' ranges, which I think if you sum the three, taking the top estimate of all of them, you get about 150. I don't know what confidence level they put on those estimates, but I think it's largely that the industry, from the information that they can gather so far, is that 150 looks a stretch on what we know at the moment. I think we'd be also in that 80 to 100 bracket. In terms of the difference, there are some firms who've not yet announced. You've also got the ILS or private capital that won't. What you can do is sort of relativity, or you have a go. Now, Lloyd's has 80-odd syndicates, and we can do some relative amounts between them. And then we look at compared to other companies' announcements and try and see if there's somebody raising an eyebrow, either higher or lower. I think with so much uncertainty, it's very difficult to reach any conclusions at this stage. I don't think there's any incentive for firms to undergun it. There's so much attention on us from regulators and from rating agents and your stakeholders and shareholders. But there are sometimes pressures on us to different things of when to actually book these numbers. You've got Q3 earnings statements for many. Do you want to get it all out the way now rather than and then bank in on a decline in the number over time? Lloyd's, we had a number in the end of September for Harvey and Irma. We were able to go out with the Maria figure where Harvey and Irma had come down by 10%. So it's pretty much a big moving feast, and sort of this guessing game about relativity will play out over time. We'll get through year end, and I think there'll be another wave of updates with annual earnings, and then it'll be replaced, I think, by the next big catastrophe event, and we'll go again.
Yeah, when you mentioned guessing game, if I look back in 2005 or Katrina, Rita, Wilma, I mean, what we did see was that a lot of companies ended up reporting adverse reserve development in subsequent periods. So I guess I agree with your statement that companies don't want to undercut the losses, but maybe, Jim, you could follow up and say your views on the loss estimates so far, and I guess the concern by maybe the investor community that there might be some adverse reserve development in subsequent periods.
So I guess I'd put us in that $100 billion camp as well. And what I can say is that I haven't seen anything at this point that would suggest that it's greater than that. What I'm seeing anecdotally in our company is that the larger risks that we have been able to adjust and get into have actually been lower than what the model expectation is. And I do think that there's a number of variables here, and I do know that every loss is different, right? And through my career, it seems like every time a catastrophe occurs, we all sit back and say, well, that was unusual for this reason. And we see with Harvey, the flooding, Maria, I think business interruption, contingent BI are big unknowns, but we need to be careful about that because it's only I think it's concentrated in certain segments of the market. So when you look at the hotel industry in Puerto Rico or the large industrial risks, you'll see a higher business interruption component associated with that. Things like the power company and its inability to get back up and running. I learned as of yesterday from our CEO in Puerto Rico that they were at 42% of power. That doesn't mean that 42% of the people and businesses on the island have power. It means that the power station is generating 42% of what it could normally do. So what does that mean? I don't know yet, and time will tell. I think Kevin O'Donnell said it really well. I think we all look at the models, we look at market shares, we look at all the information that we have at our disposal, but it's really time. And like he said, if we wait till the last claim settled, then we know what our loss estimate is or our loss is. And I think it's really dangerous, and it's a big challenge for the industry to rush to put out numbers until you know all the facts or a majority of the facts. And we spend a lot of time trying to analyze that, and it would make my job a lot easier if I woke up in the morning and was able to press a button on the computer and it would tell me what the loss is. But we're just not there, and I've been looking at losses in Puerto Rico for, I guess, most of my career. I started out back in the 80s, and we had Hurricane Hugo, I think, was the first one, and all the others since then, and they were all different, and this is probably the most severe, Maria. There's a big uninsured, underinsured element in this loss, and we'll have to see. I get the sense that Irma is more of a normal type event, and we'll be interested to see what actually comes through, because we have been able to fine-tune the models over the years, and every time there's an event, we learn something from that event, and we're able to fine-tune it. And I think the modeling folks, whether it's internal or external, have done a good job over the years at looking at those lessons learned. But as you saw with the modeling agencies, their estimates were wide-ranging, and so it's a difficult one. It really is. Yeah,
so maybe that brings me to my next question about modeling capabilities, and I think there was discussion in this morning's panel about the 4 different events. Maybe, yeah, Irma might have worked under the modeling lens, but there were different elements over the other events. So Scott, maybe if you just wanted to talk about maybe Traveler's take on reliance on models and your view post-events on using models.
And I think Mike captured pretty well in the first session that we always start with remembering they're just models. Almost always do not represent reality as it emerges. It's a real challenge in a big company to stay on top of models, to bring them in a way that's controlled, compliant, and that you would then use for external disclosure. Now you've got your auditors involved. I mean, it is an enormous, enormous process in a big company to bring in a single new peril into your modeling process, right? A single new peril. Think about bringing tornado hail in when you're a hurricane modeling firm. You don't have Missouri exposures in your hurricane models, right? So now you got to go out and figure out how you're going to bring in all of your exposures. So it's an enormous machine. At the end of the day, it spits out very precise answers that are clearly false in their precision. And so we try and bring that in. Everything we do is modeled. We try and take the implications of the model and build it back into risk loads that we push back to the product level and ultimately down to the policy level. But again, all of that's built on a whole bunch of assumptions. We're always testing the model firm assumptions. Every time they do a version change, they're supposed to provide detailed documentation of what they've done. They're not that great at that. And so we're always going back and asking, what did you really do? How does it really change? And questions like that. So we run the world on models, but as a enterprise risk adherent, I think you just have to remember that models are tools to allow you to step back and think about your business problems and to think about how you want to control those business problems in the way you sell your products into the market.
Yeah, and I would just add that it seems to me the smaller the event, the more difficult it is to get a more precise answer, right?
That's a fact of statistics.
Right.
Right? The towns that have the highest cancer rates tend to be small. They're outliers because they're small. Exactly the same thing happens in events.
And you make a good point that, I would imagine that a smaller regional company, and I'm just picking on Florida, in Florida would have a better or quicker understanding of what their loss would be than, say, a nationwide writer or a global company like ourselves, because you'll have multinational accounts, you'll have exposures from other global territories in the United States or in Puerto Rico or wherever the losses might be, and it does become more and more of a challenge the larger the company, I think.
No question. So we have we do not write indigenous Puerto Rican business, but we do write national schedules in the U.S. for customers that have locations in Puerto Rico, and we certainly cover them. We also have an operation at Lloyd's that writes an international portfolio. It's often 2 steps removed from the original customer, but clearly provides exposure and values exposed in Puerto Rico. We know how much total insured value we have. We have no idea what the loss content of that is going to be. I think this question about putting out estimates, it's a vexing one. If the storm happens on the 30th of the last month of the quarter, we're going to put out an estimate 19 days later, right? And it's going to be 19 days old, and it's going to be everything we know at the point that we're making that estimate. But we are obliged by the rules of financial reporting to put an estimate on that. Now, if it happens on the first day of the quarter, now we're going to have 100 days worth of development on that event. So It's just the nature. We all have to report. If you're a public company, you have to report quarterly. Allstate does a great job. They report monthly on their cat numbers. And if they don't report, you know they didn't have a cat over 150. They don't have to worry about, are we going to report or not? They're going to report if it fits this box. The rest of us, I think, have if you don't have a policy like that, you're in the mix of this, okay, when do I have to disclose something? We disclosed an estimate on Harvey very, very early on because of a concern about our chairman speaking at an investor event that didn't have Reg FD compliance. And so we wanted to be able to put something out so that he could actually talk about Harvey at that investor conference. By the time we actually reported the quarter, 90 days or 60 days later, that estimate, the range, we were actually outside the range of that estimate. We fell below the range of that original estimate. So is it good that we put out numbers early? It's really, really hard to know. We did what we felt was the right thing to do, but then certainly once we announced the results, one of the analysts said, hey, you got it wrong. I said, hey, we told you absolutely the best guess we had at the time, and yeah, it was wrong.
Yeah, we actually have an internal debate in-house if, because the events were so close to the end of the quarter, if it was the reverse, if it was the earlier in the quarter, would companies be as quick to report?
And probably not, would be my guess.
So maybe I'll get a reaction here on, your what you owe the public in terms of disclosures and the speed to market on that aspect.
Firstly, I'm going to put in a good word for models before we can.
Yes, see.
They do give you directionally, and when I say models, I mean what insurers and reinsurers actually do with once you get the off-the-shelf or proprietary model, what you then do with it for your risk profile. There is no doubt. Actual events can invalidate, and they're tests of it, but actually directionally, they will tell you something about what these type of events will cost, how much capital it will erode, and they're a pretty good starting point. Then you get the actual data, ground up information as and when you can get it to validate what you're saying. It definitely gives you a decent starting point. In terms of putting out numbers, all this sort of worry about in Q3, I mean, take year end. Remember, the year's not over until they're celebrating New Year's Eve in San Francisco and LA, because you never know. And then a 31/12 event, and we really would have the accountants running around in excitement. And also, these events, God knows, a major quake will tell us so much more about events. These storms, they have happened. So 2005, 2008, 2012. There is some information in the tank that modelling firms, and they do put an awful lot of very bright research people on it. That is the best information we have, but we're getting paid to take risk. So in the end, it must be uncertain. I have noticed many firms have shied away from doing ranges now. The false precision of it's to the dollar million and here it is. But I think the modelling firms have gone for ranges because they didn't want a Katrina-type backlash of, it fell outside your range. Companies now, I think, give a range, everybody looks at the top number and then adds a bit. I think for whether it's better or worse, you're better off just give a figure, say that on our best estimate right now, that's where we are.
So great. Now that we set the stage on catastrophe activity, let's shift gears on reinsurance, your reinsurance buying strategy post-events. So, John, some insurers actually bought some backup coverage, post-Harvey and Irma. So could you just speak more broadly on your belief on the adequacy of prop cat programs post-events?
Yeah, so certainly for Lloyd, that was one of the key questions we were asking our syndicates regarding adequacy of coverage going forward. I think it's good. I mean, there are such a depth of programs. People are concentrating or buying for much more severe events than these three, even in aggregate, are put together. So pretty comfortable. I think the opportunistic sort of buying that, because of pricing that we've seen, I think that's going to be difficult to replicate going forward. I think people are trying to rethink this balance between what you retain and what you pass on to reinsurance or retro, given where you think pricing might come from. But in terms of adequacy, I think the reinsurance market, I haven't seen yet that people are withdrawing offer of cover, or actually sort of scarcity of offering. Pricing might be different, but in terms of availability, not been told that there's been a shortage of that as we speak.
Yeah, because I think one of the key questions is what's the right number for the frequency of events when you're thinking about aggregate risk. So maybe I'll turn to Jim and ask you, how does these events that we've seen, how does that make you think about what the right number is for frequency?
Yeah, sure. So QBE, we spend a lot of time kind of setting our strategy, our risk appetite. And I would say for the January 17th renewal, we actually started early in 2016 looking at what we wanted to do. And we've always looked at an aggregation of losses and what impact that would have to our group. And we've bought various types of aggregate covers over the years. In the past, I guess back prior to 2015, we bought a separate aggregate risk treaty versus an aggregate cat cover, as well as a catastrophe tower and a risk excess program. In 2015, we moved to a more encompassing approach. We bought a catastrophe tower, we bought a risk tower, we bought a quota share on our captive, and we also bought an aggregate cover that protected for large risk and catastrophe losses in an aggregation. So we've been doing it since 2011, and it's been part of our reinsurance strategy. It hasn't changed. I don't think 2017 changes our view going forward. And you heard in the first panel that there seems to be a lot of confusion on where the market's heading and what it's going to be doing. And part of our reinsurance strategy has been to buy a multi-year reinsurance program. So for us, the majority of our reinsurance program for this renewal is already placed. Half of our catastrophe program, half of our risk program, half of our quota share on the captive, and all of our aggregate was multi-year, and it is part of our strategy. Now, that's not to time the marketplace. We're not doing it for a timing thing and trying to get the best benefit we can. As a matter of fact, as the market softened, we probably paid more because we were doing a multi-line approach to it than others. But it was more about certainty of reinsurance placement and protection. So this year, I think we still have some work to do. Some of my folks are in the audience here, and we're working on that at the moment. But I don't think really anything changes in our strategy for this year.
Yeah, Scott, and I also recognize Travelers has an aggregate program. So can you give your thoughts on, when that took place and how you thought about frequency of events?
We're either 2 or 3 years into, I think it's our 3rd year with the aggregate program. Second, but in any case, it's a substantial retention. We view our reinsurance protection as kind of operating between our expected earnings level and capital. So we have a $3 billion aggregate retention through the 3rd quarter. We're less than a third of the way through the retention on that. So it's a very high, high attaching cover. And the events haven't really changed our perspective. We're historically shy about what I'll call southern hurricane. We don't, as a primary company, the primary companies take all the frequency risk, all the small events, and the through the top risk. When you think about Florida, in a marketplace where the regulator lets companies run at a 1 in 100 capitalization level, there's a lot of through the top risk. And we don't believe you get paid for that. And so we're very much underweighted in Florida as a result of, frankly, our Andrew experience. We have senior claim people, and our chief operating officer were on the ground and flew over Hurricane Andrew in 1992. And it looked like the Eastern Caribbean after Irma. It was really, really that bad. And we'd known all those years that event that was forecast on Thursday night and Friday morning before Irma actually, veered south a little bit to Cuba. That's a real event, and it's in the playbook. And It's just not something we're going to put our national balance sheet at risk on. So that through the top risk is something that as a primary carrier just has to be in your mind all the time. The reinsurance marketplace operates between, pick your attachment point, what, 1 in 20, maybe, out to 1 in 100, and all well and good, but they've got limits.
Traditional
and they're
reinsurance.
Done.
Traditional
Well,
reinsurance.
even alternative capital, same. Some of it plays higher, but,
Yeah.
but not that much higher. And it certainly doesn't provide me out of the top protection. It really doesn't. And so, again, as a primary carrier, we're in a very, very different place, I believe, than most of the people that you've heard from today and that operate here in the Bermuda market. It's just a very, very different business. And we love the law of large numbers working for us. The 3 CEOs that were up here, they don't have law of large numbers working for them hardly ever, right? They just don't write enough standard insurance across enough policyholders. They've got a couple dozen reinsureds or whatever it is. But we love the law of large numbers, and it works well for us. And where we buy reinsurance, it's essentially where we've got aggregations that we feel really put our balance sheet at risk.
I think the Storm Show, for capital efficiency or protection, the wider your coverage you can purchase, the better. But that should be in the pricing from the reinsurer's point of view. Buying sort of single peril, one-off hits, it's a very different type of cover to an all-capped or aggregate exceedance type cover. But that's, that is more the diversification, right? It's one of the 3 words. That's the great thing about buying that wider coverage.
Okay, great. So maybe now we could shift gears and talk about pricing and terms and conditions following the catastrophe events. We heard Mike McGavick say this morning that violent cycle is going away. Also, Mark Granson mentioned that there's no denying that there's fatigue in the industry and something has to change. So maybe we could touch on how, what that means. We could all agree that the third quarter events means some type of pricing increase. But Scott, if maybe you could touch upon maybe how quick we'll begin to see that. How do you think pricing will evolve in 1/1 versus going through to 6/1?
Yes, so I agree with the comments that the CEO panel had, that this is going to take a little time to sort of gain traction as market. The property cat space, everybody will try and position for January 1 and figure out, okay, what can we do on January 1 covers? As folks said, the Florida market's really a June, July renewal. There'll be a lot more clarity by then, both in terms of what the losses actually are and in terms of how the capital's responded. So that'll be a little bit interesting. Again, for a company like Travelers, we're looking at an industry that's earned sort of 6% returns over in 2016, and really not believing that that's adequate for what we do. I think the narrowing of the volatility of the market cycle, along with the need for the industry to just cover inflation, because again, that's something that, boy, what business out there can you not cover your annual increase in costs? Generally speaking, we all pay for things where, if the price goes up 3 to 5%, you kind of expect, okay, the costs are going up. Here we're in an industry where we've never actually been able to convince our customers that we deserve to cover the costs of inflation. I think we need to do that, and we're going to be pushing across the product set and across the geographies. But again, it's going to be account by account. There's clearly a threshold. Whether every product, every customer, there's an increased threshold where you push your good customer out the door. And none of us wants to get to that. And I think we all realize that in past cycles, that's exactly what we've done. And I think the trepidation, particularly amongst traditional legacy insurers, the incumbents, if you will, about somehow pushing your customer out the door will put a governor on how hard people push. But at the same time, I don't think folks are willing to accept low single-digit returns for the risks we take.
And Scott, you mentioned to me when we prepared for this panel that you viewed these events as psychological.
Yeah, I think the cat losses provide a great trigger to have everybody, and Mike said the same thing, right?
Yeah.
You just wake up, the underwriters wake up and they say, holy smokes, I wasn't quite collecting enough. And I totally agree with the comments about casualty being essentially the weakness in the casualty markets, essentially being covered up by the lack of cat activity on the property side. Now that you've got cat activity on the property side, the casualty products are pretty bare, particularly on the reinsurance side.
Yeah, so maybe Jim, I could ask you what your take is on loss impacted territories versus non-loss impacted territories, and even a spillover impact to casualty in terms of pricing.
Sure. And I'll just make a comment about what Scott just said. I think it's clear everybody wants to see pricing go up. Everybody will benefit from a pricing increase, and the market's going to move in that direction. I guess I was really happy to see the last panel talk about differentiation, right? Because I do think it's important to look at the customer, whether it's the primary customer or the insurer as the customer to the reinsurance market, as to how well do they manage their portfolio, how well do they mitigate losses at the primary level. I think these are really important things, and there are companies and customers out there that do a great job at managing their portfolios, managing their risks, and they deserve different treatment from the rest of the marketplace. And so when you look at affected areas versus non-affected areas, I don't think it's as simple as that. I think you need to look at the customer. I know back in 2012 when I was working on the QBE program, and it's a fear that I have, is that we're going to slip back to not worrying about the customer anymore, right? So I found the reinsurance community wanting to sell the products they wanted to sell, not what the customer wanted to buy, right? And we need to listen to our customers. There's a price for everything, and granted, and I think we can come up with that right price, but we need to listen to the customer. So affected areas, definitely going to see a bigger increase than non-affected areas. We're a global organization, so I'm looking around the world to see what does that mean. But I struggle to find, frankly, any territory that hasn't had some loss activity, whether it's risk losses or it's cat losses. Everywhere in the world you look, there has been activity. We had Cyclone Debbie in Australia, and New Zealand quake last year. There's been earthquakes in Latin America, European storms. Wherever you look, there's been, and whether the market has responded to the pricing at the time or is about to, I think we need to look at all of that. As far as the question about other lines of business, I think it is going to spill over to other lines of business. But I think, again, it's going to be customer by customer, and what has the loss activity been like? What has the experience been like of that line of business? How diversifying is the product, right? And how much capital is needed to support that product? So it's not a simple answer that, it's going to be another 5% on everything in the marketplace. I don't think so. I think you're going to see some customers on the non-cat business with renewals as expiring, and then others that are going to have increases.
I was going to say, I think it is a trigger, right? In that, if you look purely at customers, policyholders who've got losses, that doesn't mean the price was wrong. No more than a clean risk means that the price was right. And I think if we just look at property cat, Florida, Texas, Puerto Rico, for loss-affected lines, we're going to miss the bigger picture regarding pricing adequacy across the book. Hurricanes, these devastating events, they may well be the trigger that you can see the potential damage, that the risks that we're taking. But if you look broader, because they happen so quickly, this is one for the connoisseur, right? But in the UK, we had a Ogden rate change, which is a payout for liability claims. I guess the closest thing to how you have to reassess reserves on a casualty book in 24 hours. This is the rate at which you would discount long-term payouts for liability, motor or liability claims. Right? Suddenly that cost hundreds of millions, but it wasn't like you've got to pay that cash tomorrow, it's over time. That was the closest thing to a catastrophe in casualty. But as remember, casualty is just as risky as these nat cats. These are just more emotive events. You can see the personal damage that it's done. Yeah, trigger in terms of it, but really it shouldn't be just about property cat for me.
Great. I'd like to touch upon some of just macro reinsurance buying strategies. And I think it used to be a conversation, is it traditional reinsurance versus alternative capital? I think that conversation has changed to traditional reinsurance and alternative capital. I like Kevin O'Donnell's comment this morning that third-party capital is probably more patient than cheap. So Scott, maybe I'll start with you and get your views on kind of the partnership between traditional and alternative capital.
So I think our first foray on the alternative capital side was issuing cat bonds, and we go back to right after Katrina, Rita, Wilma in our first cat bond issuance. And I would say initially we used alternative capital as a competitive lever, if you will, to sort of keep reinsurers honest and to kind of push the edges of what efficient pricing looked like. As time's gone on and as the product offerings of the alternative capital markets have evolved, we've introduced alternative capital into our main program. That's one of the aspects of moving to aggregate coverage. It's a single limit without reinstatement that allows alternative capital to play next to the traditional rated balance sheet reinsurers. So we look at them now as kind of part of the marketplace. We'll continue to fairly play them against each other and try and push the best pricing. But we have sort of rules of engagement, if you will, about how we think about our reinsurers. We don't change a lot. A couple things. We don't do differentiated pricing on a placement. That rule is a really important one if you want to maintain discipline with your reinsurers over time. We don't throw reinsurers off of a program if they've performed and paid claims and not been downgraded. So again, if you're meeting your obligations and still want to be in the business, we're not going to replace you just because a shiny object came along and said we're better capacity. So those rules of engagement, particularly in a soft market when nobody gets off of a program, have allowed for a lot of stability. And that's kind of how we've looked at it. Reinsurance doesn't drive our businesses at all. I mean, we buy reinsurance to protect the balance sheet, large property risk, property cat, big surety losses, cyber. Those are the main things that really drive what we buy, and really none of the products are dependent on those reinsurances being in place. So it really gives us a lot of latitude in terms of how we think about things. But a consistent approach to the reinsurance marketplace, from my perspective, has always just made the process a whole lot easier, because all of our markets know there's no, the last rule is we never go back. Once there's a firm order, we never go back. If we short place, we short place. We missed it, but you never go back. So once it's a firm order, you don't get the, well, I still want to get this or this or that, none of that. So again, just trying to make that relationship with the marketplace as transparent as possible, to me, is what's really helped us maintain a very supportive reinsurance panel.
Yeah, Jim.
Yeah, sorry.
Quickly, I was just saying, I think alternative capital here to stay. I definitely agree with that. I would say the relationship, I think, sort of comparable to Lloyd's relationship with Bermuda, where Bermudan reinsurers have syndicates at Lloyd's. Lloyd's syndicates buy reinsurance from Bermudan companies. It's a partnership. UK is trying to join the party, legislation trying to come out to join the alternative capital ILS world. And Lloyd wants to be a part of that. We're just going to see where we get to, but definitely a partnership that's for the ongoing future.
Yeah, I was just going to add that I think the conversation goes back a long time now, right? So we started using alternative reinsurance capacity back, I think it might have been prior to 2010. And I was interested that Guy Swain said they've been around for 20 years doing it. That's amazing. But we have tried to, in our reinsurance strategy, match capacity capital to risk, right? And our program is designed in order to attract various types of reinsurers and capital and capacity. So we buy a top and drop layer that is designed for the alternative reinsurance market, and we get more of the capacity there. We have long-standing traditional reinsurance relationships, and I don't think those will ever change. We value those. Our reinsurance program has been consistent and long-standing. So I think that conversation, I agree. The alternative capital is here to stay. It'll be around for a long time. We have alternative capital that has been trading with us back to 2010, still on our program today. And so that's a consistent market as well.
Thanks. I do want to give the audience a chance to ask some questions. You could submit it through the app, or we may have attendants in the room with microphones. Any questions from the audience? I think I see one up in the front.
Thank you. My question, James, is your comment about listening to your clients and being able to provide the product that your client wants. How closely do you listen if the client says, I'm only willing to pay X, but the market rates dictate that the rates ought to be Y? Are we listening, or are we still imposing your corporate strategy on how that contractual relationship develops?
Yeah, okay, that's an interesting question. And, there's a price, I think there's a price for everything. And you can sit at a table and you can negotiate and decide whether you want to buy less coverage or more coverage, depending on what that price is. I've sat across the table from reinsurers and had those debates as to what is the right price or the wrong price. And at the end of the day, what I don't want as a buyer is to wake up in the morning and find that we've had a loss where everybody thinks it's covered and it's not, right? And so we just need to be mature about that and sit down and have open dialogue and decide what is the right price for whatever that risk is.
I think absolutely that with that. Worst thing with a buyer is, you think you're covered and you're not. The insurer or reinsurer is, I'm paying a claim, but I don't think I got premium dollars for it. That's not as bad as the first one. In terms of pricing, it should look at the client and actually their risk profile, but there are the macro factors, the cost of capital, the balance sheet that is being put at risk to support the client. That does need to be bring in, and that's why that pricing can move depending on the other events that aren't particularly down to the loss experience of the client, but that should definitely be there as a differentiator in that pricing for the risk.
Any other? Oh, I see another question back there.
I had two questions. First for John, can you remind us what the overall gross and net loss is for the Lloyd's market for the third quarter catastrophes? And then I don't know if you had a view on the California wildfire exposure either.
To keep it Lloyd specific, right? We don't release the gross loss estimates. The net loss for Harvey, Irma, and Maria is an aggregate of $4.8 billion US. As of now, we haven't made any announcements regarding the Californian wildfires at the moment.
If I think about that 4.8 billion, that's probably, at least of the companies we track globally, it's probably the largest globally we've heard released so far. I mean, I I know it's important to look at that on a relative basis to capital and things like that, but were you surprised that it was that high?
I think I said in terms of surprise nature, Lloyd's has a pretty significant market share, US reinsurance, US surplus lines business, so I would fully expect us to have a pretty substantial loss. In terms of erosion of capital on the modelling, we've seen nothing that surprises us there in aggregate level, or actually by syndicate. It's fallen across the marketplace for our single largest nat cat peril, US storm. That's where the capital is held. At this stage, how can I comment on the relativity to others? I think you're right, Lloyd, I think is the biggest single figure there. But I think we're all in that guessing game of how strong, how much of other firms announced. And at Lloyd's, we're in that same position of looking through between the comparison between syndicates. So I don't think anyone can say which number is a strong number amongst all the announcements and which is a weak figure on what we know at the moment.
Thank you. And then for QBE, I believe in the third quarter, there was a $900 million coverage from National Indemnity that was exhausted. What are the plans on that coverage going forward? Will it be re-upped, or is it kind of one and done?
It is an annual deal, and it was done on a multi-year basis, so it resets at January 1st.
I think that's all the time we have. I don't want it to be between us and lunch. So could everyone give a nice applause for our audience?